video discussion. So last time we mentioned before of this. Today we are back on interesting part. Make sure you are familiar with our applications and conversion. And also we take that as a default. Okay. Later we'll be referring to underlying asset to call it a spot. Okay, because this is much easier. But all the content that we call for stock does apply to all other types of assets. Okay, so just this okay. So sorry for today. We tend to have some contents. Okay, so the first is still a quick review of factors affecting auction prices. Okay, typically CAP. Okay, and then first have the upper bound. And lower bounds. Okay, so after the how the factors are, we may talk about the European options because it's a lot easier. Okay, but the seriously, we have European options largely apply to American options as well. So we will talk about the difference in the variation after we have our content for the options. Okay, lower bound, then football parity. Football parity, well, also this is definitely central power. So last time we mentioned this table a little bit. Just a quick review. So for auction pricing, the M0 here referring to the current stock price. So if everything remains all else remains equal, all else are the same. Then if current stock price getting higher, typically your option should have higher interest value, and if the time value is still there, so overall the option not better off. So there is a positive relationship between S0, the current stock price, and zero option price. So on the other hand, the put option, right, they tend to be worse off. They tend to worse off if the stock price getting higher because options they allow you to sell the asset and receive money. So K is a fixed amount, right? But if you sell the asset, right, then the cost of your selling is there. So if the assets are too expensive in the market, then it should be better for you to sell the asset in the market rather than use put option. Okay, so that's another put options forces less cost. Okay, similar logic applies to strike price. Okay, basically strike price is exactly replaces a strike price exactly on the opposite direction, right? Because always, no matter how whether you use option or put option, you are earning the difference between the stock price, the stock price and the strike price, right? So if K remains the same, stock price getting higher, then if the earning of the option higher. But then if you take the stock price at the same level, but you push the K even higher, then again from your option getting lower. Right. So then similarly you the conclusion say if K getting higher, it's much easier to get profits to sell to sell stock profit. For the maturity is a bit hard to say for European options because European options are fixed date for exercise. They only have a choice to do a lot. So whether the all the price change, price difference, or eventually the higher price or it's hard to figure. It's hard to figure. But for American option, the conclusion is very, very straightforward. For American option, as long as you have longer time, you should have more chances to realize some profits throughout that exercise. Okay. So next is it's the volatility. Okay, we use the standard deviation as the proxy for the volatility. So now we are referring to volatility for the stock price in the future of the historical development. And you can see that this line is the most special line with all sides positive. That means no matter you use European or American, whether you use all food always as well as the food is at the higher, you should get back. Okay, so options should get benefit. It should be more expensive. Actually, this should be a big point. We got in the next of the SOP, we talk about the statistics about the binomial tree pricing process, about how to determine the price of an option according to the binomial tree model. So we will talk about a theorem of the result of theorem. So that result actually have a very simple, very special argument saying that actually the core for option prices is very different from any other asset prices. So any other asset prices, you tend to have the price determined by their return analysis. Like that in a very comprehensive way, we say it is more like a return analysis. No matter you do fundamental analysis, you can start model, mechanical model, residue model, this and that. Or you do a technical analysis, or you try to explore the arbitrary opportunity, whatever you do for common assets, those common assets tend to have a price based on those return related analysis. But for the options, it's or most of the contingent claims, their return may come from volatility rather than the price of return itself. Okay, this is sometimes counterintuitive. So if you check the first line like this, yes, at zero getting higher, the top compression also getting higher. It is but then if you argue that actually volatility is a better one, then the asset price itself really we find it become very see why this is reasonable. This is the most interesting part of the options. Okay, so interest rate or precisely risk of the rate. This part is also okay. First, we now talk about dividend first. Okay, so for dividend topics that you know that we understand how policy, we understand dividend that it is the most direct way we get that on investing from the stocks. Right, the stock, if you're referring to a very typical dividend discount model, the stock price, that's usually the most stuff. Okay, we have the offer as this. Summation of distributed payouts. So that means according to this kind of model, we can conclude that in this way. So stock is actually a summation of all future capital or all future dividends. Okay, so dividend is a part of the stock value. So if the dividend payout comes off, if the dividend payout occurs, it's actually paid out a part of the stock price to you to let you get back part of your investment. Okay, so an immediate conclusion is that if everything else is equal, coming as the same as before, then this dividend payout actually pay out for part of the stock price. So it should intuitive that the stock price is lower. Okay, and we know that if the stock price is higher, the counter price is higher than lower. Then with the dividend here, dividend actually is stock price lower. So your conclusion should be like this. Right. So a similar conclusion can be held for risk of free rate. So if a risk of free rate is there and risk of free rate getting higher, definitely this risk of free rate affecting the discount rate we have for any kind of fundamental analysis model here. This discount rate, if you refer to the dividend discount model, this is a cost of benefit. Right, if you replace the dividend with free cash flow, it's a discount rate. This should be your back cost of that, weighted average cost of capital. Right, this all depending on your benchmark, which is the risk-free rate, plus your risk-related profile. So thinking about the straightforward case, so if you are just favoring risk-free investment, okay, if the risk of the rate is higher, then the current value, the present value of this risk of the investment should be lower. So for all other risky assets, the similar logic applies. If the risk of the rate is higher, then the discount rate for that for all future cash flow is higher. Then intuitively you should have that lower, then we should have the same conclusion as we had before. Well, so here it turns to be a problem because in the side here, we exactly have the opposite conclusion. Why? So if you check the writer of the book, they actually trying to establish the distinctive feature of risk of treatment. So they think they argue that actually this part is not really a distinctive feature. So they only want to include the and this is actually not the diagram that you need to go through this at zero. So their argument is that so if I assume that at zero level two, in any case, what happens is the risk of free change. Okay. So actually risk of free change will have a direct effect on option prices as well, which exactly result in the opposite direction. So the key here is that the cash benefit changes a little. Okay, for the call option, assuming that the call option's K is 100, that means if I have a favorite time point, you need to exercise this call option, you need to pay this line to stop. So to prepare for your payment, maybe right now, but you can prepare some money into a risk of investment so that usually if you get enough interest, then the money invested will kind of pay here. So if the risk of so if you check the present value of this K, the money you need to prepare should be this term, like K that this is the present value of this K. So you have R here, right? You have risk of free rate. That means if the risk of free rate is high, you actually need to prepare less money to fulfill your contingent requirement here. Right, so if the risk of free rate is 5% per year, maybe you need to prepare 95 a year, that is enough. So in the future, if you need to emphasize luxury, you just pay this $100 because of this, right? But if the risk of free rate is quite low, even zero, then you need to prepare 100 to pay about 100. So for put option, similarly, put option will let you receive the pay, right? By paying the stock to the counterparty receive pay. This is a fixed amount you will receive at a certain exercise date. And the present value of this future cash inflow is also this term. So that means if the risk of free rate is high, the actual cash benefit I receive from the put option have much lower, much less present value. Right, so that means that the risk of free rate actually making your benefit from put option not that favorable. Right? So the conclusion here, if we have a direct link between the risk of free rate and the eventual of the price, we will conclude exactly the opposite as we compare to the former one. Okay, you will conclude that actually the call option price should be higher, put option price should be lower. Okay. So if you check the pattern, the writer also says that it's a big part for us to conclude the overall impact of the risk of free rate on power driving because it's quite natural for us to expect that the risk of free rate will affect the stock price and in fact also even the C amount, right? So and the more in-depth right, if you consider about the company's position, if the company has a very heavy debt financing, then rising risk of free rate may also change the company's operation, especially the company's liability burden from getting higher. Maybe the company are unable to pay out dividend in the future. So that this will be more very, very complicated, right? Once you consider about the overall comprehensive effect of the risk of free rate. So we just give you kind of two ways by thinking about risk of free rate. The direct way, the indirect way through price. Okay, hopefully that can help you to play the game in your life. Okay, next, a very simple, argument. Okay, for the same option, okay, comparing an American European option, the American option tends to allow you to have more chances to exercise, right? Throughout their life period, you are always able to do exercise. So American options is it allow you to have more chances. So typically comparing to the European option is all other conditions the same. The American option should be more expensive. Okay, so we have the capital letter, the uppercase C rather than the lowercase c, the uppercase Q rather than the lowercase q, right? This is quite easy to understand. Right? So next is the upper bound for complement function. So we can use the say the arbitrary argument interface here. So we have two ways to get the same result holding a star. Okay, in previous chapters, we compare future contract and holding the stop. Okay, now we change the contract a little bit, comparing the option and the stop itself. So we can buy the stock here, hold it until now, or we can buy the stock at any time point, at any time point here. Okay, so our cost will be the stock price. We can also buy a call here, exercise here. So our cost is C and K. So to determine the upper bound, we can imagine the case that we can have the largest profit. Okay, so for different options, we tend to have the largest profit when the stock price is just too high. Okay, the stock price is just like 1 million per share. Something. Okay, then the strike price is 150 or even $50. Totally negative. So in that case, this often can bring pretty much a lot of value at a future time if the future stock price is this, right? But if a current stock price value is S, and eventually it will lead to a very huge 1 million value, this investment is also very successful. So comparable, if we imagine about the most optimistic case, when the stock price will dramatically increase to just too high, making the case not is even negligible, we can have our conclusion for the upper bound like this. The upper bound of C should be exactly the price of this underlying asset. Okay? Because the best case is when you manage that the stock price is just too high, even the stock price is too high. Okay, so the case is negligible, but still you stand as C here, just like you stand as here. Okay, so at least your stock price should not be higher than the underlying asset price itself. Otherwise, if this cost is even higher than S, then you need additionally you need to pay the pay. Right, then the first way to get the side is much more costly than the second way. Basically meaningless. Right. So this is upper bound. So we are not really talking about the fair price of the C, we are talking about the upper bound. So this is the boundary you can never reach. Okay, so so thinking about the boundary, we imagine about the most favorable, although very likely impossible, we imagine the most favorable case. Okay, so for put option, we can have similar argument. Put option, we can have this. We say we having a stock right now, and we have two ways to end up having nothing. But that means we will try to liquidate our position during this time. Then we have two ways. We can buy put, exercise it here. We can also sell it at any time point. Okay, so if we sell it, we get the stock price. Okay, to buy a put, we spend P. Exercise, we receive K. So what is the best scenario you can imagine for a put? The best scenario you can imagine for a call is that the underlying asset price increases dramatically to almost a positive infinite, which makes pay the delivery. And for put, what you can imagine is that the stock price drops to really zero, basically zero. Company no bankruptcy, stock equity never goes anymore. So this close to zero. This is a massive value. Okay, and you can still get a K by setting the stop to the function. So if the stock price is close to zero, okay, then this way is basically zero benefit. The above one, the benefit is K, your cost is P. So the conclusion here is that your P tends to be smaller than the K you eventually receive. Okay, because if you eventually will receive $100 through this put option, you still need to prepare the stock, right? You still need to have a stock purchasing from somewhere else, even if this is a zero cost asset. You still need to finance it from somewhere. Then if the put option is even more expensive, hey, the put option costs $120. This is ridiculous, right? You are spend $120, we eventually earn $100. This is totally ridiculous. Nobody will choose that. Okay, so the put option like this. More precisely, because our put option, if we talk about European put, the exercise date and the put option purchasing date and our specific time lengths between them. So precisely you should have it in this way. You can consider about the present value. Okay. Okay. So for American food, the conclusion is somehow very close to the same. Okay. American call, you still have the American call question never exceed the stuff. But because our imagination here does not involve any selection of timing. Right? You can buy the stuff here, you can buy the stuff here, but have a process to have a purchasing process on that you can have this kind of policy. Okay. For put option, because it's hard for us to consider about the exact exercise data, sometimes the best exercise data is just the next of later purchasing. Right? It's possible. So put option we can conclude simply American put option can only be not larger than the K itself. Okay, so this is the upper bound. Okay. Well, so I guess this is kind of one last trend for last week. Touch about artificial opportunity. Okay. So this example says that we have the carbon price rate of F020, T is 1 year after 10%, K is 18, the dividend is that in zero. Okay, the argument here is that is there an arbitrage opportunity? Okay, since we already run arbitrage for a lot of time, so we can take it easier. We can take this say let's forget about determining whether the C is too high or too low. Okay, let's just simply run an arbitrary opportunity and see whether this opportunity can be runnable. If that's runnable, if that's not runnable, then we can kind of give it up, or if the opposite can be volume, we can just refer. Okay. So let's try. Let's try first. Try to long the call. Okay, and short corresponding path. So call option tends to let you have the asset by the end. So in this way, let's do this. Let's shorten stop. Okay, this is the what you can look at. Possible. Possible. So this is the now and do the analysis and you the exercise date. So long call, you pay the call option price first. You short the stock. Short the stock means you borrow the stock. Short selling, if you sell it, we see you as a zero, and you invest in the equal risk free. Right? This is a common practice we have. So in the exercise today, we have two possible scenarios. The first scenario is class E, larger than K. The second is smaller than this amount. So in the first scenario, the call option is profitable, it's exercisable. In the second scenario, this call option is worthless. For simplicity, let's go with the second scenario first. In this scenario, the call option is worthless. So this, although you pay the fee, hopefully vested. So the only thing remains is this position. You borrow the stock, sell it again, it's at zero, you invest in this rate. And this investment will eventually let you receive your principal plus your interest, which is this term. Right? And there is no options trace to believe risk. Okay, so you still need to pay your liability, your stock borrowing. So what you need is pay the stock price, receive the stock, repay your liability. Okay. So what is our net profit? So throughout this process, we have some operation here, but we don't have any actual profit or loss here. So we only have some cost. And here we receive this, pay this. This two, like we receive the stock offset these positions, kind of ignorable. So profit is what is our profit here? Really well. Okay, so what is our profit here? Uh-huh. Okay, start close. Okay, there's 2 points. Okay, so first is that this you need to pay the ST here, so this is also the cost. So for the total price, you pay it here, and you consider about your profit at this date. So precisely cost is ST, and then C also this curve. Okay. So this is the net profit. So the first scenario is the ST is larger than K. In this scenario, tau is the exercise is the profit. So you will always use the tau. Okay, but before we talk about how much you pay for the tau, how about what you receive. Okay, don't forget that you invested your money. Okay, so you still have the same investment outcome. So with the option, now you pay the K, you receive the stock, you repay your liability. Okay. What is our profit here? One, two, one, two, four, one, two, four. Using, what is our profit?
I see. The pay.
That's all. Okay, okay, perfect. So this is our profit. So the kind of running the arbitrary opportunity here, and they have two profits. So we have some unknown number here, that's T. But this is not really a problem because we have this unknown number under this scenario only, and this scenario already mentioned as T is lower than K. That means what? Means this value is lower than K. Right? So this is a value of deducted. That means what? Means if we count this profit as whole, this profit will be larger than this profit, right? Because this ST is lower. I think if you deduct a lower number, then this value should be lower than this. This should be a higher profit. Okay, so to make the arbitrary opportunity possible, to make the arbitrary opportunity possible, at least this profit should be positive. Right. This one is definitely more profitable than this. Okay, so if we make sure this is positive, then this is definitely must be positive. Okay, so the only condition we need to meet to make the arbitrary opportunity for all always profitable is Okay. Then adding back, so reverse it back to our previous argument. Why we argue about arbitrage? We're saying that in the market, to determine the fair price, to determine the equivalent price, there should be no arbitrage opportunity. So simply say, to make the prices fair, we should have this equation reversed. We should have this term negative. Okay, that means if to make sure this price is fair, this must be negative. This thing we don't know. We don't know, but we know this should be a higher value than this. But as long as we make sure this is a negative value or at least zero, this arbitrary opportunity is not worth it anymore. Because arbitrary means we don't take risk, we don't have pure profit. Okay, but here, if you make one outcome zero or negative, so you are more like an investor, you have possibly receive more, possibly receive less. This is never an arbitrary opportunity anymore. So this is one determine the fair low amount for the option price. We modify this a little bit. We will have a conclusion like this. Okay, and to make it closer to the real situation, we know that some of the option their K is just too high, right? The K is just too high, which makes the call option an out of the money option. Okay, and then if you follow this way, then this number will be negative. But call options tend to always have a closing price. So we modify this a little bit. We remove RT, so this K is discounted to the present value. Our is the C, the half is lower about this expression like this. Okay. So we can have some kind of similar place to make this argument. Okay, right? So for this put option case, still let's forget about whether the put option is valuable, it is too high or too low. Okay. But in the previous case, we make sure both profit positive, so that eventually that this again is runnable. So we can do it in the same. Okay, so now we draw the put. So the short position here is slightly different. The short position, always the short position depending on the outcome corresponding to the derivative, right? For future, it corresponds to stock. Call option also stock, but for put option, with put option you only get cash. So you need to short cash. Well, this sounds a bit ridiculous, short cash. Okay, but you have the comparable asset, which is a stock. So here, in a more precise way, we tend to borrow to buy. Okay, so here our action is a P here. We borrow money. Buy the stock. hold it until the end. Okay. So we still have two scenarios. And we still have two scenarios. So the first scenario is as T is larger than K, usually if the stock price is too high, selling the stock through the put option is not must. You rather selling the stock in the real time market and as T rather than selling through or getting just K. The real time market is so here in the further scenario, put option is missing. Then the only position remains here. You have a stock, you borrow at zero. And this borrowing, this liability increase over time because of the interest rate. So your action is you need to sell the stock. Okay, because now it's the time for you to close the position. We are running the arbitrage, we are not running the investment. Okay, selling the stock and as T, repay your debts equals to this term. Only one. So what is our profit here? Uh-huh. Okay, that's all. Okay, can you go? Any suggestions? There is one mistake here. Any suggestions? There's a small mistake here. Any suggestions?
parity. So, is that?
Oh yeah, RTR, yes. D is dividend, but D is zero. Okay. Jimmy, there is a small mistake here. Let me correct it. Okay, we run out of time, so deduct the total offer price is always here. Yeah, so not really K, but ST. Yeah. You receive ST, this is the only revenue you have. You need to repay your debt. Also, this is the upfront spending you have for options. Okay? So if ST is smaller than A, now is the time for you to act out, try to put option to have some profit. So now if you using the option, so you can sell the stock, gas, pay, still repay the same amount of debt. Okay, so in this scenario, you have K again. Okay, other things remain. Oh, this is that, this is the total price. So you still have a unknown here. But this unknown number, very lucky, this unknown number happens in the first scenario. And we already say this ST is larger than K. That means what? Means that this line, this profit, as long as you have a larger number here than this profit should be larger than this. Okay, so this one should be the lowest. And to make sure this arbitrary opportunity runs very well, at least this profit should be positive. Okay, if only we make sure this profit is positive, then this must be positive. Now this is always even out. So if there is an arbitrary opportunity, we can say that this term K as P is larger than. Okay. So to make the price fair, you have to reverse it, you have to do it. In the end, we have our total of those argument, which is this. This is how you run. Well, so usually, come to this part, I tend to do less with our because now with our account. The situation is more complicated. The problem is more complicated. Previous case, you have that. Also, you have this do the same, but you don't have two scenarios. So here is a bit more complicated. So usually, up in this stage, I tend to introduce it in another way, which is so-called portfolio comparison. The portfolio comparison line like this. So we can have an example. I use a PDF for refer to portfolio. That's like my personal abbreviation. I like to use of the portfolio. Okay, so we have portfolio A, portfolio B. So we have A, then we can having call option. So this portfolio to form it, we want to prepare the cash So we can prepare a cash vehicle. We call it a zero compound. Because this account, okay? So their principal will equals to K. Okay, we just have this as a cash vehicle, so we can deposit this amount and get K. So this K can work. We need to pay for the call option. So always to compare with the call option, we want to use the off call option. Okay, so call option off call is the stock. Okay, so now ignore all the kind of cost of this portfolio. Let's do a comparison like this. Okay, we just considering the payout of this group. Okay, so this is a portfolio A, portfolio B, as P larger than K, as P was smaller than K. Okay, so what's the law? What is the outcome B under this scenario? So the first scenario is that the larger than K and then so the portfolio B is much smaller. So what is a payout? I'm not talking about comp. Okay, the payout is stock. Eventually, the value of this stock is what? Okay, so the outcome of this is very simple. It does not change under these two scenarios. So the outcome is always the stock value. So what is the outcome of it? If the stock price is favorable, we exercise it. If the stock price is not favorable, we will give it up. Under this scenario, if you have the call, then you only have the bond. So this model will give you a confirmed return, which is K. If the scenario getting better, this one will allow you to pay K, which means all the money you get from 0.5 down to spend. You pay K throughout the option, get the stock, so we run out with as T. A and B under the same scenario, under the first scenario, they are the same, outcome the same. But under the second scenario, we say second scenario as T is smaller than A. That means what? Means portfolio A is perform better than portfolio B under the second. So taking them together, that means portfolio A will at least perform at least the same as portfolio B, and sometimes it will be better than B. Okay, getting back to this case, might be arguable, that might be true. We say that arbitrage truly should not exist when we have the fair price asset. So if we have the fair price of this call, portfolio A and B should not form any arbitrary truth. That means what? Means since A have better payoff compared to B, then A's cost should always be higher than B. That makes it fair. Otherwise, if A and B have the same cost, then everyone will long A short B. Right? If they have the same cost, then you long A short B, you have zero cost at the beginning. But once the situation gets to the second scenario, you will get a net profit. And the worst case, end up with nothing. Okay, that's how I run arbitrage. So here, with this mechanism, we say because A's payout sometimes better than B and never be worse off. So A's cost should always be higher than B. So what is A's cost? A's cost is C plus A U and RT. Then this one should be larger than S zero. Your cost control is portfolio. Okay. So this is this is still what we have for the lower bound. A similar argument is like this for put option. Portfolio C, we have a put, and to make sure that at the maturity of the exercise date, we can pay the asset to receive the money. So the put should have a stop going with so that if we want to exercise, we have a stop deliver. If you do not want to exercise, it doesn't matter. Then for D, we want it to be comparable with the option outcome. Put options outcome is money. So D, we still use this to outcome. This is a principle equals to K. So their payout runs this way. Their payout is under the first scenario or the second scenario, D always does not change. D is always K there. Okay, D is just a 0.1. We already have a very simple assumption here. Okay, it does bring K. But for the put function, first scenario is not profitable, so only stock remains. Second scenario, put option is profitable. We exercise the put option, deliver the stock, getting back K. C and D under the worst scenario for the company, they have the same outcome. But under the better scenario, ST larger than K, right? That means what? Means here this one is larger than this one. Means C performs better than D under the better scenario. That means what? Means C perform better than D in some cases, or at least the same as D. And in an arbitrary world, in a complete market, C's cost should be higher than D's cost, so that there is no arbitrary. What is C's cost? C's cost is P plus S0. D's cost is K E S R. So this remove the S0 to that side. This is what we have here. Something magic still exists. Okay, something magic. So the analysis for portfolio A, B, C, and D. If you take all of them together, C's outcome is ST or K. A's outcome is also ST and K. We are arguing that if you have better payoff, you should have a higher cost so that the market is fair to everyone. Then if you have the same payoff, same payoff, C. If in all different scenarios your payoff from these two portfolios are the same, then these two portfolios tend to replicate each other. So the cost of these two portfolios tend to be the same. This leads to our conclusion like this. Basic cost should equals to C's cost. This is the so-called put parity. Okay, putting it into a normal world. If you have the call option and put option for the same asset with the same strike price maturity, this call and this put, their prices must fulfill put for parity established in this formula. Okay, this is one of very important conclusion we have. This is much easier for us to use when we do the arbitrage, right? Here you have inequalities. It's a slightly hard for us to utilize, but here you have inequalities. Going to be more straightforward. Okay, we have 5 more minutes, so we can have a small interesting part. Okay, small interesting part. This is one application for football parity. It's okay. Let me write down the word so you can take a picture. Okay, so I utilize this part. Okay, so this at the first glance you will think about oh, this is kind of too specific, so special. Like we learned this, you call it important, but I only feel that this is only applicable in the open market. What is the matter for us to learn this if I don't really want to spend my time in open trading, but I don't really want to do that job. Okay, so this one does not stop here. Not stop here. If we have one sequence called real option approach, which actually talking about how to use the option pricing method to help us understand the corporate finance structure. So this one, our this foundation like this. So we have the kind of permanent equation for accounting statement, right? So asset, liability, plus that. Okay, you can also call it debt, right? And the different scenario, different name. Whatever this is liability, this will have this kind of permanent. Okay. So thinking about averages. So the in the worst scenario, the company goes bankrupt, you get 0. Right. So no matter how bad the company eventually end up is, you get 0 as long as the company goes bankrupt. Whether the company still have 1 share in the office or the company even have no shares, no fixed asset anymore, the company end up is bankrupt. So you are compensated. So after a certain point, the company getting worse, you won't get worse. You end up with 0. But beyond that point, okay, beyond that point, if the company getting better, you are the only one, you are the one solely enjoy the benefit of the company's growth. Right, that holder cannot share that with you. That holder have a fixed claim on the company's asset. But you don't, you are the remnant claim all the remaining. Okay, so your payoff is like this. Okay, at a certain time point, so at a certain break-even point. So if the company getting worse, so if this line is the company's overall value, asset value. So at a certain time point, at a certain value point, okay, if you get lower than that, your outcome is 0. And you have get higher than that, your outcome is getting higher and higher. So this is exactly the payoff of a call. So the equity is also a call. Liability. Liability will let you have 2 outcomes. If the company does not have any bankruptcy announcement, then you will have a fixed claim. Okay, no matter how good the company goes, the company can be very confident, but your fixed claim is there. It's okay. But at a certain time, certain point, which is the company's bankruptcy point, you can only claim the remaining of the company. So as long as the company is remaining getting lower, so this, we know that the put option is run like this way. This is a short put option. And since it has some multiple here, it also has something efficient option. Okay, so precisely say that this claim is more like this. Okay, with this term, it will make sure that if the put option don't work, you will get paid. And with the put option, you make sure that if you get ahead, if you get away, so if you get beyond this review, this bankruptcy point, you'll get less and less. So your asset value there is equals to the summation of this and this. If you move the P to this part, we exactly get back to parity. That means what? Means with the balance of parity, we can understand corporate structure, corporate finance structure in the way of option. Okay, and later you can see that later we'll talk about the black swan option model, option pricing, so we can exactly give the option of fair price, any kind of option based on this figure. And this is the huge step. So that means you don't need to run those fundamental analysis and things to think about company's value. Rather, you're using the option pricing for call option pricing for this put, so you can determine the net value of the company as well as the equity value of the company. This is kind of a huge point. Okay. Okay. So last point, sorry, so let me kind of sentence. 但是赢 OK， 董子博不能冒三，黄静雅 OK， 交流专这个要对方家居，刘建峰 OK， 孙轩刘洋冒三。貌似红桃比前一个，是他，王是王是一个杨是好像，杨新奇，杨新奇，杨一超是 X， 于超一见不认识。Okay, okay, good. That's all for today.